So when you come back here now, when you talk about, when you come to the diagonal spreads, they are more or less the same as calendar spreads. The only difference is we are now we are just changing. We're not using the same strike prices. We at least spreading them out. But
like
all the other,
with the calendar.
Yeah? Yes, but now we see with the calendar, the strike price for the long-term call is the same as the strike price for the sale of the short-term call. Okay. But now when you come to the diagonal spreads, all conditions apply, but now the strike prices are different.
Okay.
All right, but let's just go through it and understand what this is, what we actually do mean. So we'll be looking at the call diagonal spread, and then also the optimal diagonal spread, then also the diagonal spread trade management. And as mentioned earlier, the approach is almost the same. And eventually want to reduce the cost of this trade, but also try and profit out of it. And how is this going to happen?
So is this one going downwards to, I mean up to?
It can go either, but for the purpose of understanding the approach, we'll be using a call, but you can apply to a put depending on the market. If the market is more bearish, then we'll be using puts. We'll be buying and selling puts. If it is more of a bullish stock, then we'll be considering buying or selling calls. All right.
Okay.
So let's look at it from this illustration. Again, you're using the stock Apple, and Apple is at currently trading at $130. So we are currently looking at this stock being mildly bullish, neutral to mildly bullish. And what you do, we implement the same. We say that we are buying a 6-month long-term call option, and for this we're receiving a credit offer. We are paying a debit. We are paying a premium of $13 out of that purchase. Then again, you're going to sell a short-term call option of 1 month, and for this one, we are going to sell it at a higher strike price of $150. Okay, and for this, we are receiving $4 as premium out of this. So in essence, you are reducing the cost of this trade from $13 to $9. Okay, so this is what you stand to lose in case this market goes hayway, or no, if it goes against us our direction. So what kind of risks do we have? We have risks if the market rallies upwards, isn't it? Because I will need to liquidate that some position, or will be losing more on the sell side. Okay. So what we are saying here is that if the debit is less than the width, then there'll be no losses on the big rally. The width here being the $150
and 130
less 130
less 20
$30, which comes to $20, right? So if that width is greater, if the debit which is $9, so this one is the debit. If the debit is less than the width, there'll be no losses on the big rally. And in this case, the debit is at $9, while the width is at $20. Okay.
Yeah. So if the width debit is less than the width, no losses on big rally. So the debit is 9, the width is 20. So when you say no losses on big rally, it means what?
What this one means? let's take an instance that let's look at this way. We have bought the 6 month at 130. Let me have it here. We have bought it at 130. Okay, then we are selling it at 150, isn't it? You get it? Okay, from this point of view, you can see that, right?
Yes,
So
yes.
out of this move, what will happen if price goes beyond 150, meaning it is rallying way above 130 and heading towards 150? What will happen is
Junior.
when price moves towards 150, or maybe gets to 150 or above 150, it means we'll have to liquidate. Maybe the owner or the buyer of this, let me use a clear diagram at least. So let's have something like this. So let's say we have bought here at 130 and you are selling
At 150.
at 150, isn't it? So look at it this way. If price moves to 150, it is getting from 130 to 150. It means for this buy call, the 6 month buy call, we are actually gaining.
Okay.
Isn't it? Because price is moving upwards, isn't it?
Yes.
Okay. And out of this, if it gets to 150 or above 150, what is going to happen for this sell that we have here?
It will start losing money.
It will start losing money, isn't it? And by losing money, it means that the buyer of this option, the 1 month option, might decide to exercise their right, isn't it?
Yeah.
Because price is above 150, so they decide to exercise it, and that means that you are obligated to meet that demand, isn't it? So it means that you have to go ahead and you need to sell, isn't
Sell
it?
it.
You need to sell to you are obligated to sell to them once you decide to exercise that right, isn't it? So if you sell at them at 150, because that's the agreed price, isn't it? And at this point, it means that also at this 150 level, if you're going to sell, what are you going to what are you actually going to sell? You currently don't have any stock that you're going to sell. So what do? You have to come back to your 6 month call to exercise your right to buy that call, isn't it?
Yeah.
Is it so? And at what price will you be exercising it? You'll be exercising at $130.
So when it start going the other way, so yes, at when it's going up, by the time it gets to 150, you need to get out, right?
Yes. By the time it gets to 150, you'll be looking at liquidating this position, because now, okay, maybe as above 150, little above 150. Okay. So if this is the case, then it means you don't, if you have to exercise this right, if you have to meet this obligation, you have to have some underlying shares or stock to sell, isn't it? But at this point, as much as priced as 150, you don't have that stock currently. So the only option you have is to go back to your 6 month call option and now exercise your right of owning that stock, of buying it, actually buying it. Is it? And as you look at it, the agreed price that you're going to buy it is at 130, isn't it? As much as price is now at 150, you are going to buy it at 130, isn't it?
Yeah.
So in that case, it means you're going to buy at 130 and come and exercise it and now meet your obligation of selling it at 150. Is it?
Wait a minute. Can you go back a little bit? So by the time you 150, okay.
So okay, let's look at from let's start from the basics. When you sell a call, what does it mean? It means you are obligated to sell the underlying stock at the agreed strike price, isn't it?
Yes.
So in this case here, you are obligated to sell.
Yeah.
All right. So this means that if you look at it, we have bought at 130, but now we are coming to sell it at 150. So we have made a profit of $20 out of this buy, isn't it? Tambo?
Yes.
Okay. We are already together. Am I making some sense?
Yes, you are.
All right. So, and remember, our net debit was $9, isn't it? Right?
Yes.
So it means eventually our profit will be $20 less $9. So meaning our profit.
Are you taking away the wheat minus the net debit? Okay.
Yes. Yes.
Got it.
That is why we are saying here that if the debit is less than the width, no losses on a big rally, because it will just cancel it out here. Let's say, for example, our width here was maybe 135.
Yeah, that's short.
You see, so it means that if we exercise our right, if we meet our obligation here at 135, from the stock side we'll be only gaining $5, but you see the cost here is $9. So meaning eventually we'll end up at a negative. As much as you have gained some ground on the buy side.
Okay.
Makes sense?
Yes, it makes sense.
All right. So whenever the debit is less than the width, no losses on a big rally. And this is something we'll be looking at as we try to implement those trades. Then, as you have seen, two possible outcomes is Apple above 150 in 1 month, then have to buy back 1 month call with the profit, because you'll have to liquidate it, as you have been explaining here. It is now above 150, right? And if Apple is below 150 in 1 month, then this sell will expire worthless, but will still be owning this buy call. Okay, and you can only lose from it if price plummets downwards. But as long as price is above 130, then we'll be in the safer side. All right.
No. Yes.
So it's just the same as a calendar spread, only that now we are just now having this barring the strike prices for the buy option. I mean for the buy call and for the sell call. Okay.
Yes.
But the whole idea is being able to reduce the cost of the trade along the way as the stock plays out. All right. So so let's look at optimal diagonal spreads. So for the optimal diagonal spreads, we are looking at the long leg being 90 to 180 days, to expiration.
Oh, because you're buying it
Long term one.
months, yeah.
Yeah. Then the short term, we're looking at 30 to 60 days to expiration. Okay. Then for the buy delta, we're looking at 50. And for the sell delta, we're looking at 20 to 30 delta, which can be a call or a put, as we're going to see shortly. Okay. Then it's also best when short-dated volatility is higher than the long-dated volatility, because when the short-dated volatility is higher, we'll be paid more premium on the sell side, right?
Oh, best when short-dated volatility is high than longer-dated volatility.
So we want this one, volatility to be high.
Okay.
For the short leg, and for the long leg, you want the volatility to be low. That is in comparison to each other, because when it is low, it means you are going to pay less premium.
Okay.
Right?
Yeah.
So you want to be as cheap as possible. You want to take advantage of any opportunity to make it cheaper. Okay.
Yes.
Then we are looking for earnings with mildly bullish or bearish outlook. So if it is mildly bullish, we'll be considering calls. And if it is mildly bearish, we'll be considering puts. All right. So you don't want something that is aggressively going downwards or aggressively moving upwards. Okay. So that is the optimal diagonal spreads.
So you want something that goes up like mildly and also goes down mildly.
Yes. So some stocks could be moving downwards, some could be moving upwards, but not too aggressively. Just mildly or aggressively.
I think Apple is a good example. It does that.
Okay.
Yes. It will move up and then it will move down, but not big jumps. It will take like weeks to go $1.
And that is now when you can really gain on the short leg, because within 1 month it expires worthless. You keep that premium. If the conditions still remain, you again go ahead and either roll over or short another one. Again, sticking to that conditions, you go ahead and implement it throughout until when those conditions change. And you might find at some point, if you do it more repeatedly, you might find now you have reduced the cost of that trade to zero, and now making profit on the short leg, especially like a stock which is not moving that much, just playing, stagnating a bit, moving slightly upwards and that, or downwards, stagnating, then just moving upwards. So you want to take advantage of such conditions. All right.
Okay.
So let's so if you look at it, actually the only difference here between the diagonal spreads and the calendar spreads is just the delta for the short put. Delta for the short for the short put or call. That's the only difference. But the rest, the long leg, the short leg, expiration, they're the same. The conditions are the same.
So the delta has to be
20 to 30 for the diagonal spreads, because remember, for the diagonal spreads, the difference is that we are applying two separate prices for the strike prices, for the buy strike and for the sell strike.
Yeah.
So that's why you're having a varying delta for the sell side. But when you're talking about the kind of spread, since you're having the same strike price, both of them are considering a delta of 50, both for the buy and also for the sell.
Oh.
But you're going to see a comparison shortly.
This conference will now be recorded.
Sorry. I'm so sorry.
No problem.
I was trying to put it on my
So,
computer. I can have a big screen.
okay. So now you're talking about approaching how are you going to manage this trade. So in approaching and after expiration of the first leg, if you still maintain your longer term, neutral, mildly bullish or bearish view, then you can go ahead and roll your short call or put within 1 to 2 weeks of expiration.
Oh,
Or you
so
can
this
go ahead. Yeah.
is exactly like the calendar.
Yes, it's almost the same. The difference, the conditions are the same that you want to find. The difference is the strike price for the long call is different, is lower as compared to the strike price for the short call.
Okay.
All right.
It's different strike price, and then it's okay.
All right. Then so if you're if you're getting to the expiration, or it's already expired, and you still have that view that that stock is neutral to mildly bullish or bearish, then you can go ahead and roll your short call or put within 1 to 2 weeks of expiration. Or you can go ahead and sell a new call and put based on the 30 to 60 day and 20 to 50 delta call or put. Okay, so just now trying to get some more credit from that sell. So you either roll over or sell that and you sell a new call or put based on this condition that it has 30 to 60 days to expiration or a 20 to 50 delta. And the essence of doing all this is to continue to lower the cost of the long call or put. All right.
Okay.
Up to
So
that point, does it make sense? Is it clear?
So you roll out, because it's a little bit clear because of it's kind of repetition to the calendar.
Exactly.
Yeah. So you can like sell. Can you get in and again?
On the short side, you can get in.
Okay. Yeah. Once you sell, you close out one, you can get in another one.
Exactly. As long as the conditions still stand. That is
Okay.
neutral to mildly bullish or bearish.
Mm-hmm. Okay, that's how people make money when the stock is like diagonal. I mean, the stock is like horizontal. I used to wonder how people make money that way. Yeah, like
Sell.
stock is moving a little bit, like 130, and then it goes to maybe 135. Then it comes back down again to like 130. Or it goes to like 140. Then it goes back to 138. So, okay, continue. You can sell a new call based on 30 to 60. But we want it to be one way, going one way or both.
We can have
bullish.
If it is going upwards, if it is more like having a bullish outlook, but slightly bullish, then we can now deal with calls. And if it is showing some bullishness, mildly bullish, we can buy a put and go ahead and sell also a put to that effect, because in both cases we'll be earning a premium out of that sale of a put. Okay.
Can you say that again?
All right. Let me put it this way. When the stock is moving upwards, or has a potential to go upwards,
Yeah.
definitively we'll be looking at owning that particular stock, right?
Oh. You're looking at owning it?
If it is having a bullish outlook,
Okay.
isn't it? Under normal condition, we'll be looking at owning that stock, isn't it?
Mm-hmm.
But now you also want to profit out of it. That is why you are going ahead and buying that the long-term call option, because it will give you the right to buy that stock. Okay, because it's having a bullish outlook. So you want it to go, if for example you're doing the traditional purchase of stocks, purchase and sell of stocks, you don't want to purchase a stock that is having a bearish outlook, isn't it?
Yeah.
You want to purchase a stock that has a bullish outlook. So in essence, you are trying to own this stock, but now coming in from using a call. So you are buying that call, a 6-month call, because you are seeing it having a bullish view. So if you get to own this stock, there's no problem, because it's also having a potential to move upwards. Okay.
Yeah. Okay.
But in that scenario, you also want to be profiting. You want to reduce the cost of purchasing that stock, or having that right to own that, to buy that stock at the strike price. So what do? You start selling some call option out of it, which, because it is moving slowly, or it's moving mildly, then most likely it is going to expire worthless, and you'll keep the whole premium. But the overall view is that this stock has a bullish direction, and I would want to own this through this call. But out of that, it is expensive for me to just buy it directly from this call. So I want to start reducing the cost of that call by selling the calls on it. So more or less, you're using that long the long-term call as a security for the short term. You see that?
Sell a new call based on 30 to 60, and it has to be 20 to 50 delta. Okay.
So you see what I'm talking about. So eventually you are looking at, okay, maybe sometimes you may not see it that way, but in essence is that you are trying to own that particular stock. But as you own it, so if you get assigned that stock, you won't worry, because after all you're looking at owning it.
Yeah.
Right?
So the intention of this kind of spread is, like, in quotes, you're looking to own it, right?
Exactly. Yes.
So when you buy it at 130 and it goes to 140 and you own it, you're making $10 like profit, right?
Exactly.
So if you own it, it's like you bought it less money. Okay. So one question.
Yes,
when
please.
you exercise that, when you exercise it, like, let's say you exercise the contract and now you own this shares. What about the sell option? Like, do you still have to close it, or you have to do them together?
The idea when you get into this setting, that is at the diagonal spread, you are as much as you are trying to own this stock, you are not really emphasizing on owning it. But if you get assigned, there's no problem. Okay. And in fact, if you look at it, the only time we'll come back to Caesar right here is if maybe now this stock goes way above, and that sell, we need to meet that obligation, is when you come back to say that, right?
Okay.
But if you're not been assigned, the sell option keeps on expiring worthless, and you're not required to meet the obligation, then you'll just keep it running, keep it open. But then it gets to a point whereby now you find that the conditions have changed. Maybe the sell option has expired, or may expired, but now you are looking at getting into it, and you find that no, these conditions have changed. I cannot go ahead and sell another call, but you still have an open long call option on the other side, isn't it? So that's when
Yeah.
you go ahead and now exercise it and book that profit that you have already earned on it. Am I making sense?
Yes, yes, yes.
Okay. So we are saying, look at it this way. We are saying, hey, I'm putting myself in this setup that I want to own this shares. I mean, this stock at some point, and I've been charged $13 to own this stock. Well, for me to make a profit out of this, the stock needs to move plus $13 from my break even. I mean, from my current price upwards for me to start making a profit. So this is quite expensive for me. So how can I go ahead and start reducing the cost of this one, so that even if it moves upwards, I'm still at least going to get some profit out of it? So what do I do? I start selling call option based on this one. So I sell the first sell, and maybe I get, like we said, I get $4 out of it. So this means that I've reduced this one from 13. Now we are at 9. Okay. Then the condition still remains. I go ahead. This one has expired, worthless. I go ahead and sell another one. So the second one, maybe this one I get, let's say $5. So what happens? It reduces this one further. Now it is worth $4. Okay. So at $4, at a cost of $4, if I go ahead and liquidate my call option at the end of it all, the profit I would have earned on that move will be able to offset any balance that will be. It will be easier for me to offset $4 rather than $13, isn't it?
Okay.
Okay, so that's why we are going ahead and implement it that way. Does it make sense?
Yeah.
Okay. So let's now look at let's look at the other direction. When we can be implementing a put, we buy a put and a sell a put. Okay. So by definition, when you sell a put, okay, when you buy a put,
You want that that stock to go down.
so it means that you have the right to sell, so isn't it? So you want the stock to go down, isn't it? So this is the right to sell. Then when you sell a put, it means that you have the obligation to buy. Okay. So in our case, we are looking at this stock is having, we want a stock that is having some bullish characteristic, I mean some bearish characteristic for us to implement this. So we are going to say that if this stock is having some maybe slightly bearish, neutral to slightly bearish. So what do? I go ahead and buy a long-term put, because I know it has a potential of going downwards, and I will also profit out of that put, the put I've purchased, isn't it?
Yeah. Yes.
So what will I do? So these are 6 months or around 6 months. I buy a put. Buy a put for 6 months. So this means that it will cost me out of this purchase. Maybe I might be charged, depending on the type of stock. I might be charged, let's say $15. Just an example. Okay. So this is quite expensive. For the stock to move from my strike price, it needs to move plus $15 or $15 lower below my strike price for me to start making a profit. Okay, so if the stock was, if maybe I bought the put at 150 here, so the price needs to move downwards, maybe to about 135. So from 135 is when I start making a profit in this scenario. Okay.
Yes.
Okay. So I wouldn't want this case. This is too expensive. So what do? I go ahead and sell a put. Okay. So out of this sell, I'm obligated to buy at that strike price. But because this stock is showing some mildly bearish characteristic, yes, it's bearish long term, but it is having, let's say, short term, it is slightly bearish to neutral. Okay, so I'm anticipating that if I sell this put, maybe I receive $5. There's a high probability that it's going to expire worthless. So in this event, it's going to reduce my $15 from 15 to $10. So what it means that for this long-term put option that I've bought, now the price needs, when the price gets to move from 140, I can start making a profit. You see that?
Because it's 15 minus 5. So
Exactly.
okay.
So instead of now coming from having to wait for it to get 135 for me to start making profit, if it gets below 140, I'm in the money, I'm making a profit. Okay. Then also I find that maybe again the conditions still hold. So this one has expired worthless. I go ahead and sell another one. I sell another put. Yeah. And for this also, for example, I say I get another $5. So now this one is reduced to the cost reduced from $10 now to $5. So what that means is that instead of now 140, price just needs to move from 145. Once it gets from 150, my strike price, and gets to 145, below anything below that, I'm in the profit. Okay. So we are doing that continuously until when those conditions change. If you can reduce it to the point whereby now you are at zero, the better, if the conditions allow. And now you can even now start making additional profit on it on top of the profit you're making out of the actual long puts that you had purchased. Okay.
Yes.
So you can see now on the opposite side what you can also achieve, as opposed to in comparison to the long side. I mean the calls, when using the calls, and also when you're using the put.
Why does the put sounds more easy to understand?
Really?
Yeah.
Okay.
Maybe because you the way you started from like the basics. Yeah, that makes sense.
All right, that's good to hear. So we are going to implement, when you implement the trades, you're going to have a 1 for call and 2, I'll set at least 2 for the put side. So you see how they'll play out. So let's do some comparison.
So do they,
compare.
for this one, the optimals, are they similar, or that's where you're going?
Optimal for both the calendar, optimals for both the calendar and diagonal spreads.
Mm-hmm. I mean, for no, I'm asking about when you go to the put side, because first you did the call, and when you go to the optimal, is it the same as when you're doing the calls as well?
Yes, it's the same. Remember what you said here.
Okay.
Optimal diagonal spreads. It is either 90. Both of them you're looking at least the long leg to be at least 90 to 180 days, and the short leg to be at least 30 to 60 days. Okay. Then when you come to the deltas, we are saying 50 delta for either the call or the put.
Oh, okay. Okay, that makes sense. For either column. Okay, I remember now.
All right, and the same applies for the cell, that is 20 to 30 color put. Okay, so let me so let's compare. Let's have a comparison of optimal calendar spreads and optimal diagonal spreads. And I can see in terms of the expiration, both of them are looking at the long leg being 90 to 180 days, and also for the calendar spreads, and the same for diagonal spread. And if you look at the short leg, 30 to 60 days to expiration for the calendar spreads, and 30 to 60 days to expiration for the diagonal spreads. So more or less the same. Then, in terms of deltas, for the calendar spread, we're looking at 50 delta for the buy, for the 50 delta for the call or put. Then for the sell, we're looking at 50, also for the 50 delta for the call or put. Just because we are just having the same strike prices for both the buy and the sell. Then for the diagonal spreads, we are looking at a buy of 50 delta, 50 delta for the call or put, and 20 to 30 delta for the call or put on the sell side. Okay.
Mm-hmm. So basically, that's the difference.
That is the only difference so far.
Mm.
Okay. Then for the candle spread, it's best when short-dated volatility is higher than the long-dated volatility, and so is that for the diagonal spreads that are best when short-dated volatility is higher than the long-dated volatility. Then also stable for earnings with neutral outlook, and stable for earnings with mildly bullish or bearish outlook. More or less the same. So looking at both of these candle spreads and diagonal spreads, the only difference is the strike prices. That is the only difference, but other conditions still hold across both of them.
Okay.
Does it make sense up to that point?
Yeah.
All right. So let's look at some of the trades that I had looked at earlier. So I think there's been a few movements, but you're going to look at it and see if they still hold. So one of them is the 3D Systems Corporation. So the category is technology, and the reason I chose this one is because price stuck in between the resistance level at 35 and support at 30. We expect price to range within these levels before progressing upwards. So let's look at it and see if this, although this was on Sunday, let's see if those conditions still hold. If they hold, we go ahead and implement it. Is that okay?
Okay.
And you saw the dragon.
Mhm.
The dragon. You saw the dragon in the sky.
Mhm.
So that was triple D, 3D systems cooperation. So let's see. Triple D. So the reason we're given it is that price is stuck between the resistance level at 35 and support at 30. We expect price to range between these levels before progressing upwards. So generally it has a bullish outlook, but let me see. 6 months. We're looking at a price level of 30. You can see this resistance level, this region, and it was 30 and something. Okay, there's some small shifts. 30, 35. Yeah, exactly 30. Around this price level, you have the red line. So this region and the 30-point level, which is about here. So we expect, okay, the outlook is bullish, but now we expect this price to range between this region before now going upwards. So we want to take this advantage that it might get stuck here for some time, so that you can now gain some premiums out of it. Then it proceeds on the upper side. Okay. So this is just a normal call for this one. So if I were to implement it, let's just modify this and say it's a long. We are having a bullish outlook, so you're looking at a long call diagonal. So if you look at the long term, that is a buy for, we have said it's 30 to 1. I mean 60 to 180 days, isn't it? The long side. So you have November 19th and 64. Can we have a closer one? Let's take July 30th. So from this one, we'll be paying $5.7. $5.7 and receiving $1.11. But then again, you remember when you said about what you said about the width and the debit. Do you remember Tambo?
Say that again.
Okay, from what you have here, we are looking at implementing this this diagonal spread with
Yes.
the buy for an expiration of November 19th at 155 days, and the sell side to have 43 days to expiration. And for this one, for the buy side, you are paying a premium of $70, and for the sell side, you're paying a premium of, we are rather receiving a premium of $1. Okay.
Yes.
Do you think it can work? Is it okay?
155. It has to be. It has to be 90 to 180 for the long, 30 to 60 days. So yeah. Okay. Strike price at 35. Yes, this is fine.
This is fine.
Yeah, because you think so? It has to be. It has to be 90 to 180 for the long. That's 155. So it's not 180, but it's between there. And then the sale, the long call, the sale, it has to be 30 to 60. And this is 43. And then the debit has to be less than the width. Which
so in this
is,
case,
the width is, oh wait, the width is 5. The debit T minus 1, 4. Oh, I minus the wrong one. Okay, 470. That's very close.
470. But at least it's supposed to this the good range that the width is greater than the debit.
Yeah.
Okay.
So does it matter even if it's just like 30 cents difference?
So it depends on, but no, I think since you're just meeting that condition that it is less than that amount, it should be okay.
Okay.
Because once it hits that strike price, then we are out of it.
Okay.
Or what we can do, let's see if we can make some little changes here. Let's try and see if we can get a better strike price, maybe for the.
Yeah, you need to get another strike price, like a lower. I mean, higher.
So if we go, that is 35. 34, but there still be a problem. It's only just a small variation because now it will be, actually it will be a problem.
Yeah, so
right? It will be optimal. And then you see also the deltas. As much as we have, we want a 20 to 30.
We want 30 to 60.
The deltas, 20 to 30.
The diagonal, or is this? Yeah, this is a diagonal. So the cell needs to be 30. No, I'm saying the wrong one. It has to be 20 to 30.
And in this case, you're having 28 at 35, right? Which is okay
Yeah.
for the short side. And for the long side, let's see the 30 is at 0.58. So which is the closest that you can get? Or if you can go more precisely and maybe go for a 34. But not 34, that width will not be optimal. So the best you can do is actually the most optimal, because if you go to 29 at 0.60 at 60 delta, then now the width will be a problem because the debit will be higher, right?
Yeah.
So our best shot is at 30. Okay, which is okay because the width is greater than the debit.
Yes. So that
Right?
that one is good. Yes.
All right. So let me just update here. Then we can once start implementing, just implement it directly. So we are doing buy at 30 and sell at 35. So still this condition still holds. Then the sell strike expiration is at July 30th. Okay.
Okay.
Then let's look at the FDX Corporation.
The operation now.
So this is the FDX. So my initial rationale here was the support level at 3 or 4 has been broken and price might range below that level before dropping further. This was on Sunday. Let's see. Support at 33 or 4. So this level, it has been broken, right?
Yes.
And the price came and actually it's on its way downward, right? But again, we expect some support level at this level at around this area. So as much as it's going downwards, we might find some hesitation over here before maybe breaking down and going further downwards. Or at times, it might want to retest these levels that it had broken.
Okay.
So that is why I thought it could be, we can buy a put in anticipation for the price to go lower, but not that aggressively lower. But now also because it is laying between these two support and then the broken resistance level, then we can take some advantage to earn some credit. I mean, to earn some premium out of that sell, the sell of a put. Do you understand?
Yes.
Okay. So let's see if we need to make some changes. So for here, I'm going to modify this, but now I'm changing it to the outlook to be bearish.
Yes.
So bearish strategy. Then I'm long put diagonal.
Oh, that's how you need to choose it.
What? Okay, not enough strike prices. Okay. Let's try and just construct it on our own. We see I had it at buy at 300 and sell at 290. So let's see, does 300 meet the condition? That is at 290 negative 60. That delta is okay at 290, and then you're paying a premium of 16.30. That's quite. But also let's change its expirations. Actually, we cannot have this one. The farthest you can go is as for 64 days. Can you go for that as much as we have 60 to 180 days? Do you go for? Can you go for the minimal?
No.
The
When
buy
you say
side.
buy side,
Mhm.
if you go for that one, no. On the buy side.
Remember that the optimal diagonal spreads, the long read can 60 to 90. Yeah, it's 90 to 180.
90 to 180. So that's 64. That's no.
Yeah, 90 to 180. Yeah, that's an outright no. So this one I'll have to get. We'll have to get another one. All right. So let's check. Maybe let's check with the lift and see if it can. We can implement it. Okay, so let's look at the rationale that we used. So retest of the broken support at 60 with a clear reversal M pattern with bearish engulfing candlesticks. So it's actually retesting this level, the 60 level, is it? Because it broke it, it came back to retest it, and most probably it might revert back to the downside. You see that?
This one. Can you say that again? So it's slightly.
So there's this initial, maybe I can draw some. There's this initial, this level that was previously at 60. That was previously, when price was above it, was previously resistance level, right? So price came and broke below it. So once a support level is broken, it becomes a resistance level. And most of the time when a support level is broken, price tends to come and retest it. And here we are retesting it. Okay. So we expect that after retesting it, it might go ahead and start moving downwards again. But you expect some resistance also on these levels. The 54, 55 level, we expect some resistance at this point once it is coming downward. So you might find that it might be stuck here for some time before maybe going further downward.
Yeah.
You see that? Then there's also some, if you look at the candlestick patterns, they also tell you something, the reversal patterns, whereby if you look at, there's what you call the M pattern. It retests the level back and retest. These are a bearish reversal pattern. So price might tend to go down. And if you can look at it this way, it has moved up to this resistance level it came down. It is on the second leg of the M. So what do you expect? A downward move. You see that?
Yeah. So that is always the direction of the stock. Like normally that's how they do. Like how do I learn that? How do I learn to draw this line?
Okay, you want to look at the behavior.
And are you looking at 6 months? Are you looking at 1 week, 30 minutes?
I'm looking at 6 month long term. Okay. Because you're looking at implementing this strategy the long term, which is about 6 months. So I'm looking at it. What happens is I will tend to look at the behavior of price at a previously support level, resistance level. So like this one, how it is behaving around this
6 to 50
level, it's showing some sense of reversal. And there are so many out. In fact, there are some more. There are some more. Apart from this pattern, there's also some additional signs that you can see. The candlestick patterns, like something here we call the bearish engulfing. Let me clear this.
You call the
Bearish engulfing. So that we use this more on Forex, but it actually applies also here. So if you look at this candle, these two candles, this is a reversal because the downward, you see the red one means price moving downward, right? Then the green one means price moving upward, right? Is it so?
Oh, my phone died. Sorry.
All right.
I use my phone for the audio.
Oh, boy.
Okay, say that again.
So what I just look at this level is some cues, and I'm seeing cases for a possible reversal. First of all, I can start with and this one is also a reversal. This three combination. This is called an evening star.
At the evening star. Wait, those are many times you're telling me.
No, the emphasis is not on really the terms. The emphasis is on trying to understand the behavior at this level, these resistance levels, the behavior, what you need to really to make a decision.
And this what people call the fundamentals.
Sorry?
And this what people call the fundamentals.
No, this is the technical. Now the candlestick patterns.
Ah.
Okay. And this is what you find on the in the studies.
Okay.
Okay. Then another sign. So this is a sign that we are looking at going to the downside. Then there's also another, this one, which is the bearish engulfing. And this is because the preceding, okay, the previous candle is green, which is the upside. But now what happens is it gapped upwards, and it engulfed, it covered the previous candlestick. If you are to stand on this other end, you cannot see this other side because it has already been covered all through. That's what we call the engulf, meaning that we have more sellers at this point than buyers. Then also the last one is this one, a rejection candle. It is rejecting this price level. The bulls, the best way to push it upwards, but then there's some rejection from this level, pushing the price back down because of this long wick, upper wick, that is making it behave like that. So from this point, I can tell it's more likely this price is going to turn and go downside, to the downside, probably progressively. But again, we want it to behave that way, progressively, not too high, too fast moving downwards. And what will deter it from moving fast downwards is this support level that's going to encounter at about 55 level. So we'll be looking at these two. We'll look at these 2 points, these 2 things. So that is why I'm thinking we can go ahead and implement that. We buy a put on it, then we sell a put to see if we can benefit out of this stagnation as price tries to wrestle out within this price range. We can at least have that sell expiring worthless and booking some profit. All right. So if we are to is that clear, Tambo?
Yes.
All right. So let's see what prices can we consider in this case. So I'm going to modify this, and we are looking at a bearish view, a long put, diagonal. Then okay, the buy is at 120, not badly off, and then the sell at 64. Can you really have this one 30 to 60 days? Can you have it at 64? Or you can adjust it to maybe 23rd. So do you think can you implement it as it is? That is, we have an expiration of 43 days. That is July 30th and October 15th.
No, we cannot.
Mm-hmm.
For diagonal, it has to be 90 to 180. The long one.
90 to 180 days, isn't it?
Yes.
But this one is at 120.
That one is 140. That one is 43. Oh, okay, it's opposite. Okay, now I see.
Mm-hmm.
I didn't. It was opposite. The buy was down and the sell is okay. And then the down one, the sell has to be 20 to 30.
Mm-hmm. So you need to check that. Huh?
Yeah, so that's okay.
So let's see the 57.5. Oops, this one is at 40 delta. So you need to adjust maybe to 30, 55. Okay, let's see at 30. Then this one is the delta is matching. I think for the best bet here, we'll be having, I think for the sale, we'll maximize it to 64 days.
So you think 64 is better because of the strike price of the wheat?
Yes. And if you look at the deltas, at 55 in this case, it is good because it is at 33 for the sell side. And for the buy side, the stock price, those at 60, at 47, and you're looking at 50, which is okay, right? That is in terms of the delta.
Okay.
Then if you look at in terms of the width and the debit, the width here is at okay, the width is at $5.
The debit is at 582. 5 something, 528.
I think it will be 4.
Oh, 4, yeah.
So it will be at 4.18.
Okay, yeah. That's true.
So the width is at 5.
Another
and the
thing.
is at 4.18. You asking a question?
Yeah, so when you get these examples of trades to choose or to get in, because now you have to really adjust it severally, where do you get them from? Is it the same thing that Chris was saying when you click on the arrow down there on the options play?
Yes, you can check from this end, like if you check the credit spreads.
Mm-hmm. So when it says a credit spread, you have to come up with what kind of spread you're choosing, right?
Yes, you'll have to come up with a strategy. But one thing that I can tell from this other side, I can know if it is bullish or
Okay.
bearish, isn't it?
Right.
So if I'm looking at it, then I can see if I can implement it as a call or a put, based on if I'm having a candle spread or a diagonal spread.
Okay. Okay.
Okay.
So
yeah, this is a good place to start off from.
okay. So like for this one is bullish, you see bullish, but then there are puts. All these are puts, right?
Yes, all are puts, but you can be bullish by selling a put, right?
Yes.
And you can be bullish by buying a call.
Yes, that's true.
Isn't it?
Mm-hmm.
So either way, it depends on what strategy you are actually implementing.
Mm-hmm.
Like let's say, for example, let me try and see here. Let's start from the largest. Let's see the ID rank, the volatility rank. Like we have this X showing some bullishness, right?
Yeah.
This is quite some, because this is quite high.
Those are the prices. Oh.
Let's say something like this GPS. Let's just see how it is behaving. But before I make those changes, let me pick these values because we're going to implement it.
Mm-hmm.
So this is 5560. Then the expirations are October 15th. Okay, that is okay. And August 20th.
I think it's when I was holding the phone.
And August 20th. Okay. So we're going to implement it later. So we are saying we're looking at X. No, PXD. Let's just PXD or X, GPS.
But then again, Chris said that you also try to make sure you avoid the earnings.
Mm-hmm. Yeah, because the volatility, the kind of movement that you experience during earnings.
Yeah, because that one has a earnings coming up in the month of 8/26.
Mm-hmm. This is August, eh?
Yeah. So GPS is line 13, but you're on line 12.
Oh. Huh?
You're on line 13, but GPS is on line 12.
Oh, here it is. This was an earnings in the next 70 days.
Yes. So that is within the range of the diagonal.
For the short term.
Yeah.
But can you risk it with the long term one?
Yeah, you can.
Okay, let's look at it and see if it offers technically. So this is the GPS Gap Inc. So it's generally bullish, right? From this point, it also has some good support here at 30. So you don't expect it to go much downward, right? Then on the upper side, we have the main entrance here will be on level 35, between 35 and 37. It may also get stuck there. So if you have to implement, if you want to implement as a diagonal, then we can go ahead and buy at the current and then sell at above this resistance level, maybe above from 38 going upwards. You see that?
Yeah.
But now this one has to be, we have to deal with the calls in this case.
Yeah.
Okay. So let's see what are the optimals that we can get here.
Can you draw that W that you were drawing with this one for?
Okay, let's see. Not all will depict those characteristics. It's just being able to identify on a specific map. I mean, on a specific chart. So this one, it is quite funny, and I think I can really wait on this one because I'm seeing something different. Look at it. Let me pick up pen. This was initially a good resistance level, right? Based on this, it was more like a neckline out of this movement, which was forming this, coming to this, and now this. You see it? It may not be that clear, but what I'm seeing also, it may have broken this resistance level. At night, it's retesting this level to continue moving downward. There's that possibility. Or this is a possibility that it has come to test this resistance level, then it just failed to go beyond it, and it is moving back upwards. So I think I would maybe sit back and see how it
does fast, because the change here is either downward or upward.
Yes.
You can't really predict for this one, right?
Yes. So if it gets to 34, then I would consider that to the upside.
Right.
But if it comes back below this resistance level, this support level, then we'll be considering a possible downward move.
So is this within the 6 months? You're looking at it within the 6 months?
Yes.
Okay.
Okay.
Yeah.
But maybe there's something you can monitor. But I don't think myself I can implement this trade now. I'll wish to wait and see.
Yeah.
how it
So
plays, maybe for the next 1 week or so.
okay, so that's another reason, because one reason was the earnings was coming, another one you're not able to predict whether it's gonna go up or down, right?
Exactly.
Okay.
We need further money. We need to see the where it's going to move, how it's going to play out maybe in the next 1 week or so. Maybe past it also sometimes it stagnates this way because it's waiting for a catalyst, and that catalyst could be those earnings.
Mm.
So yeah, we can wait, or we can go to we can monitor it as we look for the opportunities in other stocks.
Okay, yeah, this one we can sit back, wait.
They usually say it pays to wait in the markets.
Yeah, so when you look at that list, you have to like kind of evaluate them before you can get into any.
Exactly, you have to evaluate them. You just don't get into them blindly.
Yeah.
All right. So I think we can go ahead and implement the 2 trades on thinkorswim.
Yeah.
Let me back. Oops, I closed thinkorswim. Let me see.
Dosh.
I think there's some trades here. I'm going to review them and see the possibility of maybe closing. First.
You can mute the Mwadini is gonna be in the recording.
It is
Ish. Bye, Ish. Let me sleep.
I miss those sounds sometimes. We don't get to hear those sounds.
when were you last in Kenya?
2016. No. 20. Yes, 20. Yeah, 2016.
That's recent.
That's not recent. Yes. I wanted to come last year, but COVID happened.
COVID ileta shida.
We don't get to hear those sounds. The cock crowing. The chicken in the morning. We don't hear those.
Yeah. Called home, eh?
Yeah, it makes you miss home so much. Then,
COVID will eventually just go, and people will revert back to normal life.
actually, here people have started reverting to normal life.
Mhm.
People are going to churches without masks.
Because they have been vaccinated. Okay, so let's try and implement this one, the first one. I think we'll just do the first and the last one. Because this one is these are I'll going to check for another one, then I'll communicate. So this one is the triple D. So trade. So triple D, that is is it really the right one? Okay. So let's go to trade. So we want to implement a call for November 19th. You have November, yeah.
So this one, you're not doing like a vertical. Oh, okay, you change
Yeah.
it to
We
diagonal.
actually it's supposed to be vertical. Yeah, but I did earlier. We need to change it from diagonal. I mean to single to diagonal. Then we are looking at least a price of 30.35. 30.35. The best you can get is this one, but we'll just adjust it. So we are on the buy. Okay. So the volumes, let's reduce to 1. So the buy is on November 19th. Then the sell is on July 30th. Okay. So the strike price for the buy is 30, for the sell 35. Then for the sell 35. Okay. So you're in a 4.0 debit. So you have it as a market order. So I think with that we can confirm and sell. So those are calls, both of them. Confirm and send. All right, that one went well. The other one is lift.
Lift.
It's lift, not lift.
It's Lyft. It's like a Uber company.
Yeah. Oh, it's lift. You need. Ah, now I get to the name.
Yeah, it's Lyft. It's the same. It works the same as Uber. It's just a competition of Uber.
All right.
In Kenya,
But
the Uber and the Taxify, is it? Or what is it? What's the name? The other one?
there's Uber, there's Taxify, there's another one called VLS or V something. Then there's also Bolt.
Oh, there are many.
Safaricom. Yeah, Safaricom rolled theirs. I don't know what happened. They went silent. Yeah. So you're looking at puts 60, 55. Expiration October 15th. So October 15th. So now this one we are going on this other side. Remember, we are selling. We are working with puts. So what is it? 60, 55. 60, 55. The best can have this. Okay. So the volumes. So like by 15th October, sell where we at August 20th. Then we are looking at a buy of 60 and the sell of 55. Then both of them are puts, so a debit of 3.92. So we are having it as a market order. So with that, we go ahead and effect it. All right, so this one should wait for the market open. Then we can see how they'll play out. Is that right? All right, Otambo, any question up to that point?
I just want, I think I need to review this video, especially the charts you are doing. I like that. I'd like to learn more about that. Looking at the chart, reading the chart, if it's 6 months, 3 months, just be able to analyze it from that perspective first. Because that actually makes you make the decision of whether to get into the stock as well.
Yeah, true.
Other than the optimals that you have for that particular debit spread, because it begins there. If the chart is wrong, like you can't even execute the other optimals. It's impossible.
That's true.
Yeah, so if I learn that, I feel like I'll be able, because okay, I know how to do the spreads, but I don't know how to like draw those charts like you were doing. So even if I have that knowledge and I go to do the it's impossible for me to do unless I just use the examples that you've given me. So I would like to, when I'm able to go to like OptionPlay and get that spreadsheet, I'd like to be able to analyze those stocks and be able to make a decision on what kind of spread I can or strategy I can take with them, even if it's just one or two, you know.
That's true.
So that's the way I feel like I can learn and execute even. So that has really been an eye opener when you did that. You drew the chart, you took the GPS, you drew the lines, you did all that, and then you're able to say, yes, I can take this, or no, let me wait. I don't think I'm comfortable taking this one. So if I am able to make that kind of a decision, I think you empower me more than just even having the knowledge of this kind of spreadsheets. It's very good, yes, learning the spreadsheets, the optimals, what to do or what to check. I have that knowledge, but when I go like in the market, like right now, I absolutely cannot do anything outside of what you've given me. Unless, because let's say like a stock is running, I try to do it, I can't because I don't know how to draw the charts. I don't know how to look at the charts. I can execute the spreadsheet, the debit spread, and now I even understand why I was having a difficulty getting out. Because it's very easy to get in, especially the way you've showed me.
True.
Yeah, so I've got all that information. I can execute, I can look at the optimals, I can look at, but then it becomes difficult after that information.
That is true. Yeah, and yeah, actually, I understand, and yeah, it is quite a critical area in terms of being able to decide. Apart from the aspect of expiration, the idea of optimization, you also need to know, because as much as you are willing to lose some risk, as much as being able to put some risk on it, sometimes if you look at the chart quite well, or if you look at what is happening, you can tell that early enough, even before the optimization has happened, that you need to get out.
Right.
Rather than wait all the way through. But also don't be too hard on yourself, because some of these things come in progressively.
Yes.
And in fact, what I would advise you to do, rather than with the charts, especially with the charts, first of all, try to identify the support and resistance levels. You see, if you're able to identify the support and resistance levels without even the indication, like if I can take a clean chart like this one, without all this, without we have here, just clean chart as it is. Let's say this one, you see, you can be able to identify the key support and resistance levels. You see, that's the first step, because even those the candlestick patterns, all that technical, the patterns and all that, they're actually just as they're useful if they're occurring at a key region. Out of those key regions, those are support and resistance levels. You see, because market behaves, you'll find some behavior at a particular support. Like if we have a level like this one, you'll be keen to see. In fact, if I'll be trading this one, I'll be looking at if there's a support level here or a resistance level here. If price is at that level, now I'll take a keen interest, and now start narrowing down to now the details. What are the candlesticks here? What are the chart patterns here? Is it in an oversold region? Is it an overbought region? So that one is I can start now adding things up and making a decision based on that. But you see, the approaches we're coming from top down, whereby from bottom up. We are starting with the main ones, which is the support and resistance. Then once you can be able to draw, because also just drawing support and resistance level, you have to train your eyes also. It may not be that outright immediately. In fact, if they come and say this one is a support level, this is a resistance level, you may not be able to see that immediately. But as you continue trying out any chart that you encounter, you have or you're analyzing, first of all, start with the identifying those key support and resistance levels. Once you have identified those key support and resistance levels, then you'll want to ask yourself, how is price behaving? Is price within this area? Is it within that area? You see, because at those levels is when you'd want to either decide if price is going to either has a possibility of reversing to the downside or the upside, depending if it is at a support or a resistance level, or if it's going to break it past it. Okay, so those are some of the things that you want to first of all look at it. Then now you'll come on now to the specifics, but specific patterns, the chart patterns, the candlesticks, those what I've said, the engulfings, the morning star, evening star. Those ones come after now getting to know those resistance levels, support and resistance levels. So first of all, start with identifying support and resistance. At least if you are into trying to understand the technicalities, the technicals of any chart. All right.
Yes. Yeah, I feel like that's a game changer for me.
Sorry?
I feel like those charts are going to be like a game changer for me. It's gonna take me to another level.
All right. Let's get to it. Also, don't expect it. It doesn't come immediately, so you might feel like, hey, I'm learning this, but it's progressive, step by step. As you learn one, you get to understand more. You get to. I cannot say myself I know everything here anyway. I just know a little portion of it, but we learn every day. As the market teaches you new things every day, you get to sometimes it makes you feel that you don't know anything, because it can move erratically, like what happened the other day with the FOMC, the announcements for the interest rate and all that. So sometimes the market behaves the way it wants to behave. The only thing you can control is the risk. The rest of the rest of the aspect of the market, we can only try to anticipate, but not predict. All right.
Yeah.
Okay. So I think can have it at that. I will find a tool that will replace this FDX, and then we can share I'll share the details and on either the group or even just the PowerPoint. I'll update it, the online version. All right. Is that okay, Matambo?
Yeah.
Then I think some of the trades here, I'll be reviewing them. I think there'll be there's some potential close-ups or
those with 29. Yeah,
like
they're almost to 21 days.
But Moderna has played out well so far.
Oh yeah, today it went up $4.
Yeah. So far, in our case, it is at a P&L of 1870. Not bad. NXPI. Yeah, this one is also due 29 days. You can start looking at it. Yeah, I look at it, then I can communicate on what we'll do next. If it will be closure or rollover, we'll decide. All right.
Oh, yeah.
Okay, so I think we can leave it here unless there's any question or clarification.
So we'll check on those ones. Okay, so are we done for today?